the markets are so focused on what the Fed does. This is kind of the ongoing risk, is that the markets aren't being driven by fundamentals. They're not being driven by valuations. They're not being driven by things that you would normally trade off of. It's simply a function now of what's going to happen with the Fed next. Are the Fed's going to cut interest rates or not? I think that's still one of the big risks as we start to look out to this year, this reflation narrative. And you see this across asset classes. Industrials have been surging, basic materials have been surging, commodities have been doing well. And this is all kind of this narrative of this reflation trade where we're going to get above trend economic growth, but no inflation this year. But that's going to be very difficult to kind of manufacture, because if the action that we're seeing in equities right now is representative of this actual economic reflation story, and that is what's going to come to fruition over the course of this year, just stronger growth by in and of itself is going to start to pull inflation higher. And that's going to put the Fed in a tough bind of continuing to cut rates. So, one of the bigger risks this year may be a Fed that pauses or slows down rate cuts, or even, heaven forbid, have to hike rates because you're getting a reversal in inflation. And because of this stronger economic growth, you start seeing wages pick up, you start seeing inflation pick up, and all of a sudden this whole narrative of low rates supporting the markets can become a lot more challenging.
Some of the Fed voting members are saying we need to address labor markets. Some of them are saying we need to make sure inflation doesn't slip any higher. We want it to come down. If we do get this really good economy, call it 3 to 5% growth, there's no way that the labor market continues to stagnate. It's got to improve. So if it improves, that one worry at the Fed is gone. Now it's all about inflation. If the economy is doing better, we would expect inflation to rise. It's hard to be dovish in that environment if we're back to producing 150 to 250,000 jobs a month, but let's just say inflation is stuck at 3%, maybe even starting to drift a little higher. It's going to be hard for any member to really say we need to cut rates here. I think that's a dynamic the market's not thinking about. The Fed that has no choice but to A, not cut, but B, consider raising rates.
And that's going to impact things like valuations, the discount rate. Again, the whole hope is the Fed's going to cut interest rates, so we're running up stocks based on the discounted rate of future cash flows, so we can justify that because of lower rates. But that can change pretty quickly. So when everybody is bullish, when all experts agree, something else tends to happen. And that's kind of the problem with the markets right now. Everybody is expecting this reflation narrative of economic growth with no inflation. The Fed's going to keep cutting rates. And because of that, we're willing to very much overpay for asset prices right now, which seems to leave a lot of risk of disappointment during the course of this year.
Catch me daily on The Real Investment Show. The link is in the description.